Welcome to Kitco News. I'm Niels Christensen. Joining us today is Christina Hooper, Chief Investment Officer at Invesco. Thank you very much for joining us today, Christina.
Niels, thanks so much for having me.
I've actually been really excited to talk with you because last time we talked, back in February, you said that gold prices were going to 1,800 by Q2. We hit that target, well, $12 to that target last week. What do you think we expect for the rest of the year? Has gold seen its best days or higher prices coming? What's your thoughts?
I think there's a very good chance of higher prices, but there are so many factors at play that will dictate this. And actually, I could see a range of between 1,500 and over 2,000 for gold through 2020, and I expect some volatility as we see news flow around different factors. But let me lay out the base case for why gold is supported here. We've got very low rates. We spoke in February. Since then, the Fed has cut rates about 150 basis points, so that now the opportunity cost of owning gold is that much lower, and gold looks more attractive. Also, because of all that the Fed has done, and all that the U.S. government has done, gold looks more attractive because we have a scenario where investors are concerned about growing government debt. They're also concerned about currency fluctuations. And as we know about gold, it is a currency without a country. It is essentially a store of value without liabilities. And so there are a lot of reasons why investors are I think, predisposed to own gold, interested in gold. And so I see prices pretty well supported.
Well, so I was going to say, so that's the base case, and I completely agree with you. I mean, the fiat money printing that we've seen from not just the Fed, but ECB, BOE, Bank of Canada, all of these guys are sort of in the same boat. I'm interested, what brings us down? You said, in a range between 15 and 2,000. What's the bear case scenario in this environment?
The bear case scenario is that we do see a V-shaped recovery, one that is not stalled, and one with really no real geopolitical risks or uncertainties. And so, of course, that's the best case scenario for the economic recovery, but it's one in which investors are likely to be a little less inclined to own gold. Now, of course, having said that, there is another factor at play, which is central bank purchases of gold. What I've seen, the latest numbers I've seen suggest that central banks continue to purchase gold, but that was really through, I think, March. So we don't know what the future holds, but that could certainly, central bank actions could also push gold prices higher, even if we do see that V-shaped economic recovery that just takes off quite quickly.
Just to talk about the V-shaped recovery, I mean, we saw GDP data come out, drop of 4.8%. What's the probability of a V-shaped recovery in all this? I mean, I guess if you had to put a percentage on this, I mean, what's your percentage for your base case, your bear case, and your bull case?
So I would put the percentage of the bear case for gold and sort of the best case for the economy at 10% or less. That would mean that everything would be working out perfectly, right? That we'd have the appropriate health response. And unfortunately, it's not a coordinated response, right? We have different states opening up, really rolling back lockdowns at different times, which increases the likelihood of a second wave of infections and potentially multiple waves of infections. So I think that it just limits, and of course, we also have to worry that fiscal policy might not continue to be as supportive. We've gotten a nice 4 rounds of fiscal stimulus thus far. It might be harder from here to get the fiscal stimulus that is needed. All the stars have to be aligned to have that really strong V-shaped recovery in the near term.
So I also wanted to ask you this. I mean, obviously, people should be holding gold, and I'm sort of wondering. Everybody sort of says the magic number is between 5 and 10% to, of your portfolio should be in precious metals or hard assets. I'm sort of wondering, with all of this money printing that has happened and that's going to happen, does that ratio go higher, do you think? What's the sweet spot for a portfolio?
So the sweet spot for the portfolio, a rule of thumb is about 5%, but that can there can be a range around that 5% depending upon the investor, their time horizon, their risk tolerance, all those things come into play. But I think a good rule of thumb can be about 5%.
So we've talked about your bear case and your base case. What's the bullish case for gold, and how do we get there?
So that that bullish case for the economy is the bear case for gold. But the base case, the one that's most likely, is that essentially the economy has a slow recovery, that it's halting, that it's uneven. And in an environment, we're likely to see gold hover around where it is today. Certainly, it will have some fluctuations there, but that in that environment, there's going to be enough geopolitical uncertainty. I think there's going to be a desire on the part of investors to diversify, and of course, all those other reasons I mentioned that are supportive of gold prices. And I think that probability is about 60%. Think of that as a square root shape recovery for the economy, which is better than a U-shaped recovery, but it's slower and more halting, essentially, to start with, a little bit more uneven, and so the trajectory is less attractive than a V-shaped recovery. Now, the worst case scenario for the best case scenario for gold, which is the worst case scenario for the economy, is one in which we see that significant waves of infections, where we have a double dip recession, where essentially there is enough geopolitical risk and uncertainty. Fiscal support it becomes inadequate. You have issues places like Europe, where you're not seeing enough fiscal stimulus. I mean, none of the stars are aligned in that scenario, but that would drive more investors to gold because of all that uncertainty, especially as government debt continues to increase. Perhaps this is a scenario where there is some fiscal expenditure, but it's not as effective. So all those things would come into play.
So do you think that there's enough ammunition to fight off a recession? In fact, the IMF says they expect to see the worst downturn since the Great Depression. So do you think there's enough ammunition to fight this?
Well, I've certainly been really bowled over by what the Fed has done. If you look at the Fed actions thus far in the crisis, they are just so much bigger, so many more policy actions than we saw at this point in the global financial crisis. So the Fed has become very activist, and I think it's doing a great job. Although we recognize, of course, that monetary policy tools are blunt instruments. They're not surgical tools. And so there's only so much the Fed can do. So this really hinges on fiscal policy. Now, we saw during the global financial crisis, for most countries, fiscal policy was lacking. We didn't get enough stimulus. That certainly was true for the U.S. This time around, we've seen more. There has been a significant, as I mentioned, 4 phases of fiscal stimulus. So far, so good. But if it were to end here, it would be wholly inadequate. What we need to see is a continuation of phases, really, until this situation gets much better. Because this is an issue where the Fed and in particular the U.S. government needs to create solvency. It needs to build business confidence. It needs to build household confidence. It needs companies to retain employees, because that's the way the economy that's the way it can set up a scenario where the economy is positioned to perform well once the lockdowns have been rolled back. It's absolutely critical. We could dig ourselves a much bigger hole if we don't have enough fiscal stimulus going forward. And that's a big if, right? Because we certainly have seen some infighting with Congress. Thus far, they've gotten past it and been able to pass each phase. But the stakes get higher as we move along. So it's critical that we get that state and local government funding. I think we need another round of PPP funding and so on to really continue to create solvency, provide liquidity, do all the things that we need done.
Do you worry about inflation, though? I mean, with all of this stuff going on, and I guess this is why gold looks good, but do you worry about the inflation pressures with all of this money sort of sloshing around?
I think you have to worry about every unintended consequence. I think that's what we've learned from the global financial crisis, is that while you are performing triage, you certainly have to keep in the back of your head the unintended consequences, the risks of your policy actions. So I think it would not be prudent to fail to consider that. But it is a risk that I think everyone is willing to take. There are a number of risks, right? A huge level of government debt. People are concerned about that. This is not the time to worry about that. We do have to worry about it. It has to be on our radar. But we're in an emergency situation where if we don't act, then the situation could get far worse.
Thank you very much for this conversation. This has been fantastic. I've really enjoyed talking with you. For all the information in the precious metals market, go to kitco.com. Thank you very much. Stay healthy, stay safe.